Hi, folks. Welcome to the webinar. We will be getting started in just a few moments. Thank you for joining. Hi, folks. Welcome in. We'll be getting started in just a little bit. Thank you so much for logging on. All right. Well, in the interest of time, let's go ahead and get started. Thank you for joining today's webinar, From Extreme Weather to Credit Risk, Insights for Regulators and Bank Leaders. Just to briefly introduce myself, my name is Ava Galino, and I'm a senior associate here at Ceres. And I just wanted to say thank you so much for joining, and thank you so much to our speakers for participating in today's program. Before we begin today's session, I have a few housekeeping notes. Firstly, I wanted to know that today's session is being recorded. We will be providing all participants with a link to the recording, and it will also be available on the Ceres website. And on this next slide, I do just have a brief antitrust statement. I won't be reading it, but I just wanted to leave it up just for about 20, 30 seconds, just to give folks a chance to read this. All right. And then moving on, just to give you a preview of today's speakers, we have a really great lineup of folks you'll be hearing from today. I won't be introducing everyone now, but I did just want to give you a sense of who you'll be hearing from and provide a brief overview of today's session. We will begin with opening remarks to set the scene, followed by a really informative and insightful overview of extreme weather as a driver and amplifier for bank risks. Following this, we will open it up to our panelists for a discussion, and then we will open it up for audience Q&A. And if you have any questions, please enter them using the Q&A chat feature that is located on your control panel on Zoom, and we will do our best to answer as many questions as possible at the end of our session. And with that, it is my pleasure to pass it over to Stephen Rothstein, who is Ceres Chief Program Officer, and he will be providing our opening remarks before we dive into the rest of the webinar. Stephen, over to you.
Ava, thank you for those remarks and for all that you do and for all of the Ceres team that's worked on this behind the scenes and on these issues, some for many, many years. What we're really talking about today is prudential supervision risk. That we all understand this is not a morality conversation, it's a financial materiality conversation. And that the amount of risks that banks and credit unions and financial institutions have on their books is very significant. And the reality is we as consumers and taxpayers don't know the full scope of that. First, in terms of the climate risk, I think we all understand this generally, but a few statistics to put it in context. So in the 1980s, our nation had $1 billion storm every 3 to 4 months. Last year is every 13 days. And not just it was $1 billion storm, but the storms got bigger and more expensive and longer. The most expensive natural or unnatural, depending on your perspective, event in the history of our nation in this 250 years was the LA fire. $250 billion of loss, not insured, but total economic loss. The largest event before that was Katrina. And those are headline and people know about those. But unfortunately, there are dozens of these events, again, every 13 days, where they could be a fire, hail, and these are just $1 billion events, not counting the ones that are in the tens or hundreds of millions that affect communities and property and people's lives. So the economic impact is greater, and obviously it's even more highlighted on smaller banks and smaller community financial institutions, credit unions, because they're more concentrated. So they're facing enormous risks directly from climate, but then there is also the ripple effect on the impact on insurance. clearly, if you're in for most businesses and for every mortgage, you need to have insurance. And there is both an affordability and an availability gap in insurance. There are about 2 million people nationwide that can't get private insurance. They need to use a state backup plan than several years ago, 2 million people. And everyone is facing dramatic increases depending on the state and even some places, the city, it varies. But overall, there was a 12% increase in a single year at a time when inflation is, 3 or 4%. That's very significant. And what we found, and there was a study done at NYU that highlighted that for every increment in the insurance, it affects the default rate. And what people are able to do, and there have even been counties where, because of the dramatic increase in the cost of insurance, it's lowered the overall property value in there. So that's on the residential side. We've also seen studies that show for small business. We just read a recent study that showed that 78% of small businesses report insurance-related challenges, either availability or affordability, because of all the climate risks that are facing that. So we're talking about property and casualty. It also affects other types of insurance as well. So what you're going to hear today is a very thoughtful analysis of the challenge and some of the opportunities there to address this, and appreciate all the incredible speakers and partners that we have. Just this morning, I was reading an article, and just to give context, the European Banking Authority announced the draft methodology and templates for the 27 EU-wide stress test, which includes incorporation of climate risk for the first time. So they are assessing a dedicated module to look at this. So they're basically saying, again, this is not something that's nice to have. They feel they need to understand it to understand stress test overall. So it is now really a pleasure, and I am humbled to have the opportunity to introduce Kevin Styro. Kevin, who is a senior fellow at Resources for the Future and doing some work with Ceres, we appreciate that, previously served as a senior advisor in the Federal Reserve Board Division of Supervision and Regulation, where he designed and led the Fed's micro-prudential approach to climate risk, including the climate scenario analysis for the largest 6 banks. He also co-chaired the Basel Committee's task force on climate-related financial risk and headed supervision at the Federal Reserve. So another way to say that is, Kevin's forgotten more than I know. Kevin, it's a pleasure to introduce you. Thank you.
Great. Thanks very much, Steve, for that kind introduction. And it's really nice to be here today to talk about this topic. To build on Stephen's introduction, in the last few years, we've seen this steady growth in the impact of severe weather events. Swiss Re, a large reinsurance company, estimates that insured losses are growing 5 to 7% per year, driven by secondary perils like wildfire and severe convective storms. We've seen these high-profile natural disasters like the wildfires in California and the hurricanes in North Carolina that have had really significant economic effects. And as Stephen mentioned, insurance market disruptions in terms of availability and affordability have been econometrically and analytically linked to extreme weather events. So this is a really timely discussion about how is this relevant for small banks and for state bank supervisors. And I'll start with just a broad framing point that bank supervisors generally expect supervised firms to effectively manage all of their material risks. And that's true whether the risk comes from a business cycle or a cyber event or an extreme weather event. And that's because we know how important the banking system is to the real economy and to local communities. And in this discussion, I'm going to use the term risk drivers rather than think about extreme weather events as a new risk, because that's what they do. They cause very traditional risks for banks. A flood can impact a borrower's capacity to repay a loan, and that increases credit risk. A wildfire can damage a bank's branch network, and that increases operational risks. Now, as you know, banks have been managing these types of risks from extreme weather events as long as there have been banks. But the challenge is that these extreme weather risks are growing, and these changes have some distinctive attributes that likely require additional focus and additional expertise from banks and their supervisors. And I'll come back to this point about the distinctive attributes in a minute, because I think it's an important part of the story. So taken together, that's the underlying case for why financial institutions, including banks, need to build robust risk management tools that can incorporate risk drivers like extreme weather events. Banks of all sizes need to understand if these risks are changing and then how they can manage them appropriately. This is particularly relevant for smaller institutions who have typically more concentrated geographic footprints and may lack the resources to invest in new data, new models, new expertise. So that's the conceptual case. So for me, it's really an empirical question about how material are these risk drivers and then how banks should manage it. I want to emphasize that I've said nothing in this framing about broader social objectives like stopping climate change or corporate social responsibility goals around things like sustainability. This is entirely from a very traditional risk management perspective. It's just good business for firms to manage their risks and to seek opportunities to work with the borrowers and their clients. And all risk managers know that to do this, you need to be able to identify, measure, monitor, and then ultimately take steps to manage risks. Now I'll drill down to why I think these particular risk drivers might require additional attention from banks and their supervisors. And there's really three distinctive attributes I think that make the case. First, these types of physical risks are part of an increasing secular trend. It's broad, it's wide reaching, it's not a cyclical phenomenon. And the scientific consensus is that the frequency and severity of extreme weather events is changing. And as we've seen, this can have substantial economic and financial effects. So that has implications for banks in how they think about their risk management approaches, their business models, and their long run strategies. Second, while that trend is clear, the precise realization of any climate related shocks is highly uncertain. Understanding how and when natural disasters might materialize and then propagate through a complex economy and financial sector is really challenging. It will depend on institutional factors, behavioral responses. So banks and their supervisors need to promote robust approaches and bank strategies that can yield good business outcomes and support their local economies across a wide range of potential outcomes. And then third, the future is unlikely to look like the past. So if these shocks are changing, if economies are adapting and behavior is shifting, then historical data, historical models, and expertise are likely to be less effective and less useful tools for managing these types of natural disasters going forward. So that means banks are likely going to need to invest to better identify these risks, measure them, and manage them. And that's in terms of data, models, and expertise. I think that has two implications for bank risk managers and their supervisors. First, if it's true that the underlying drivers of these extreme weather events are changing and they can have real economic effects, then banks and their supervisors can't simply assume that business as usual risk management approaches are sufficient. You'll need to take proactive steps to understand these risks and think how they're relevant. And the second is that the impact and then the risk management responses are likely to vary across the type of bank, depending on their business model, their regional footprint, their sectoral exposure, and their risk appetite. This isn't a case where there's a one-size-fits-all solution because each bank will likely face different risks. This is true for risk management in general. It's always linked to the underlying risks. So that's a high-level overview. So what can banks actually do to better manage these risks? In my experience in these types of discussions, it's often simplified to a binary choice. Either continue with BAU, business as usual practices, and assume nothing has changed, or a worry that banks will completely stop lending in certain regions or to certain sectors. But the reality, of course, is much more nuanced, and there are multiple steps along a continuum that banks are taking based on their specific exposures, their business models, and their individual risk appetites. So here are some examples. For some risks, for some situations, business as usual risk management might be completely appropriate. In other cases, banks might need to enhance their monitoring and build their capacity. This would be investing in data and analytics to understand these risk drivers. Maybe considering new tools like scenario analysis. Another approach would be to engage in a more focused way with your clients and your borrowers to understand how their risks are evolving and what your clients are doing to manage the risks and how a financial institution can support them. So for smaller institutions, this would be leveraging their relationships, the soft information, to better understand how clients are adapting and investing to manage these risks. For others, it might be developing new products to support their clients. Another avenue that banks are doing is considering the impact on their own operational risk. This would be investing in resilience of their branch network or supply chains, thinking about enhancing business continuity plans to include the impacts of both direct and indirect effects of natural disasters. Some banks are actively managing the risks, thinking about incorporating these risk drivers into their enterprise risk management frameworks through things like risk-based pricing or concentration limits, changing the underwriting criteria and due diligence. All of that is embedded within existing ERM frameworks. And then finally, in some cases, it might be appropriate to make longer run strategic decisions about business models or geographic footprint. But that range, that continuum of actions will be very specific to individual banks and the risks that they face. The first step, however, is to take proactive steps to understand the risk and then determine what is the most appropriate risk management response. So with that, let me turn it back to Holly and the full panel, and I'm really looking forward to the subsequent discussion.
Thank you, Kevin. You've gave us a lot to think about. You've shared a practical spectrum of how to think about extreme weather as a driver and amplifier of traditional financial risk. Rather than a separate category, you gave us three distinct attributions of weather, essentially telling us we know the future is different. And we know there will be more disaster coming, but we don't know when and we don't know how they look like. That is why it is good business sense to take the first proactive step to understand what potential risk can be facing, particularly for smaller community and regional institutions with more concentrated portfolio. Hi everyone, I'm Holly Lee, Program Director at Series, and I will be moderating today's discussion with two additional excellent panelists. With my pleasure and honor, I'm happy to introduce to you Rajesh Bandula, the Executive Deputy Superintendent and the Head of Climate Division at the New York State Department of Financial Service. He directs the effort to ensure New York's regulated insurers, banks, and mortgage institutions manage weather-related financial risk, including their landmark climate guidance. Rajesh spent over 20 years in risk advisory role at various investment banks where he focused on developing risk management solutions for financial service firms. We also have Eddie Seiler, the Associate Vice President for Housing Economics and the Executive Director for the Research Institute for Housing America at the Mortgage Bankers Association. An economist with over 20 years of experience, he leads advanced econometric research supporting MBA's forecasts. He previously held senior roles in Fannie Mae, where he designs the analytical framework for the landmark STAR Servicer Oversight Scorecard. Welcome, and thank you all for joining us today. We have the representative from federal regulator, state regulator, and industry leaders. So I hope this discussion will be very helpful to our audience. So Rajesh, let's start with you. As a regulator overseeing banks, insurers, and mortgage institutions, where are you seeing the extreme weather risk begin to translate into financial risk? And how should institutions think about the second and third order effects, such as the insurance stress, the borrower's affordability, and the concentration risk that are smaller and less diversified institutions? Thank you.
Thanks, Ollie, for the question. As we heard from Kevin earlier, there is growing acknowledgement that frequency and severity of extreme weather events are increasing every year. We're already seeing material impacts from these events on the various regional economies. So if you look at the NOAA data on billion-dollar events for New York, it shows that rolling 5-year average of annual losses affecting the New York State increased from 500 million in 2000 to about 3.2 billion in 2024, a 6-fold increase. So we can say the impact is here. The United Nations Environment Program Finance Initiative recently surveyed some banks and published a report on the findings called Bridging Climate and Credit Risk. The report shows that banks are already treating climate change as a credit risk issue. Surveyed banks are looking at how physical risks can affect repayment capacity, collateral values, and portfolio exposure, particularly in real estate and construction. The report also shows that banks are beginning to incorporate these risks into credit decisioning, key risk indicators, and in some cases, probability of default and loss given default modeling. That supports the broader point that weather-related risks are already showing up within traditional prudential categories, especially credit and collateral risk, even though methodologies are still in early stages of development. So in answer to the second part of your question, I would say that we all know that insurance acts as a first line of defense for any banking or mortgage institution and is an important factor considered in the credit underwriting process. In light of changing weather patterns driven by loss experiences, there are signs evidenced in many public reports that insurance premiums are going up and coverage gaps are increasing. Insurers are reducing coverage and not renewing policies in many cases. This obviously impacts credit quality of lending and mortgage portfolios that rely on insurance for some level of protection. Second, the impact of these developments on low and middle-income communities is of particular concern, especially the ones located in areas that are vulnerable to damages from these extreme weather events. These are the communities that take the longest to recover from these events, and they're large in size and spread geographically all over. So as insurance premiums go up, they are less able to afford insurance, and also it impacts their ability to service their debt, any debt, which reduces their ability to access financing also in the future. And lastly, I would say, as mentioned by Kevin earlier, that such extreme weather events can affect community and mid-sized banks in an outsized manner, because they have or may have concentrated business lines or geographies that are highly exposed to climate risks, without the risk mitigating benefit of diversification that a large organization has. So for these institutions, prudently managing financial and operational risks from climate change is definitely a safety and soundness issue. Operational resilience, the ability to conduct critical operations and to continue to provide services to customers, is equally important, along with management of climate-related financial risks for safety and soundness. So for all the above reasons, DFS issued its supervisory guidance for banks and mortgage companies back in December of 2023. In the guidance, DFS has outlined its supervisory expectations that these entities should integrate consideration of climate-related risks into their existing governance, risk management processes, and business strategies going forward.
Thank you, Rajesh. That is helpful. You've highlighted the connection between insurance market, the borrower, and the financial institutions, both on the safety and soundness side, as well as on the services to the community. Eddie, let's go to you. So from the mortgage market perspective, what are you seeing as the insurance cost, the coverage gap, and the disaster exposure affect borrowers, servicers, and the lenders? And as insurance become more expensive and less available in some markets, how are the lenders adapting their underwriting, pricing, and risk management practices? Thank you.
Great. Well, first of all, thank you, Holly, and thank you, Ceres, for inviting me. And I've got the easiest job because I'm following Kevin and Rajesh, and they've said all the important things. So basically, let's just think of a mortgage for a minute, and let's look at the predominant mortgage in the US. So it's a fixed rate mortgage, meaning the principal and interest is fixed for the life of the loan. But then, of course, there's other components that we think of for housing costs: taxes, insurance, HOA coverage, for example. So let's just look all three of them, and really, let's pick on Florida, because Florida is always fun to pick on. Why do I pick on Florida? Because Florida's insurance, is so expensive. For instance, ICE, Intercontinental Exchange, a big supplier of mortgage data, has estimated that the cost to cover, $1,000 of coverage in the Miami area is about $17. So if somebody has $1 million condo, we're talking about $17,000 per year. Moreover, the costs of the insurance have gone up in such a way that if we look back to 2019 to today, we're looking at insurance costs going up by about 70%, 70%. At the same time, of course, interest rates went up. So with interest rates doubling in 2022, accessibility became difficult for many people. But if we're thinking Florida, let's think of a lot of people who are living there on fixed income, a lot of retirees. Their taxes, their real estate taxes may have gone up by 20% in those last 6 years, insurance by 70%. So it's really straining people. Moreover, if somebody lives in a condo, since we mentioned HOA, of course, condo rules, insurance, and everybody remembers the Surfside disaster in Miami Beach a few years ago. So people living on fixed income, their insurance, from the condo perspective, has gone up as well. And, people who have mortgages have to have insurance, as we said. Fannie and Freddie, the two, government-sponsored enterprises, have very strict rules as to what insurance should be. So if there's many, state private insurance people coming in, trying to take over coverage from the larger insurance companies, they may not meet Fannie and Freddie's regulations. And so that insurance won't hold. Moreover, if in some states, and again, let's pick on California, where increases in insurance premiums are capped, certain private insurance companies have exited the markets, and people have had to go onto, the public plans. Public plans can be a lot more expensive than the private plans and may not cover as much. So it is a burden for a lot of people. That's number one. So again, just to recap, people have fixed, principal and interest, but with insurance coverage going up, it really is becoming problematic in that, you may have thought, well, insurance is just a small proportion of people's monthly housing bill. That why would that cause credit events, credit risk events? But it's come to the point where people, especially on fixed incomes, have reached the point where insurance is causing credit risk to go up. And I think that's a very important aspect. So why is insurance going up so much? That's, why are insurance premiums going up so much? And I think I think, obviously the cost of repairs and replacement have gone up, and especially when we have, the increasing number of disasters. And Rajesh talked about the NOAA chart where it shows the number of disasters if you look decade by decade, even year by year, excluding 2026, where so far we've had a low number of disasters. It's really been going up, at such a rate that, yes, we hear about the wildfires in California. Yes, we hear about the hurricanes in the east. But we hear less about other convectional storms, and Kevin did mention them, in Oklahoma, in the center of the country. Tornado Alley has shifted west. As sea temperatures rise, for each 1 degree, and correct me if I'm wrong on this, from what I understand, for each 1 degree centigrade rise in sea temperatures, the amount of moisture goes up in the air by 7%. So we've seen flooding not only on the coasts in Florida, we've seen the flooding go all the way into the Orlando area. And 2/3 of borrowers, and this is again from a McDash survey recently, with high flood risk don't have flood insurance. Why? Because the flood maps haven't kept up. And if somebody's in a federally defined flood zone, so FEMA has a national flood insurance program. If somebody is inside that flood zone, they have to get flood insurance. However, if they're not defined as in that flood zone, they don't. Unless we have, again, I'm quoting ICE numbers here, ICE McDash numbers, 5.3 million borrowers who are susceptible to flood risk yet don't have coverage. And let me just close by saying one more thing. I don't think as an industry, and I mean as a housing industry, that we've really kept up as well. So we are allowing, tracts to be built in flood zones. We're not, looking at, where to build, what to build. Yes, there's more resiliency being incorporated into buildings, but not yet. And from that same survey that I've been quoting, 74% of respondents stated that climate risk has at least a moderately influential effect in deciding where they should live. Moreover, 20% of home sellers stated that the climate risk is part of their decision to move. So, you know, um, climate risk is there, and again, we can state 20% of sellers, it influences them, but of course, in an area where there have been disasters, their house prices, may have been lowered, and it may be even more difficult for them to sell, adding again to the climate risk.
Thank you, Eddie. That is very helpful. Now, particularly the data examples. So Kevin, back to you now that you've heard Rajesh describe the emerging pressure in the insurance market affecting the banks, and Eddie's described how those insurance and increased extreme weather events are beginning to affect borrowers, lenders, and servicers. So where do you see the window for action? At what point should institutions start paying attention rather than just waiting for the pressure to appear on the traditional risk measuring metrics and their balance sheet?
Yeah, I think that's a good question. And from my perspective, the window of action for banks is right now. And the insurance market dynamics that both Rajesh and Eddie talked about are directly relevant for banking institutions for two related reasons. First, the insurance market changes reflect the underlying risks that are emerging in the real world. So that's a leading indicator for what is happening. As Rajesh said, insurers are often in the first loss position, and this is a very powerful signal about how the distribution of shocks might be shifting. And then second, the insurance market responses and the outcomes themselves are directly relevant for banks. And Eddie talked about this. Borrowers who can't obtain insurance aren't eligible for a mortgage, and that can feed through the local economy, through house prices, through demand. In addition, the borrowers who see their premiums rise have reduced disposable income and are a higher credit risk for the banks. So all of that suggests that these are impacting creditworthiness today, now. This isn't a 2050 discussion. This is how are insurance market dynamics changing economic and financial outcomes today. So given that growing evidence, it seems prudent to build a capacity and to incorporate climate-related risk drivers, severe weather risk drivers, into existing enterprise risk management frameworks. Maybe one last point. In these types of discussions, one concern that I often hear is that extreme weather events or climate change isn't the only factor driving this increase in losses or risk to banks. There's also important changes in the development in high risk areas, higher building costs, general inflation, economic growth. And all that is absolutely true. Extreme weather is not the only factor driving these economic and financial outcomes. But it doesn't need to be the only driver to be relevant. There's really good analytical work that shows that it is a material contributor to the risks and the vulnerabilities in the financial system. So that's enough to make it relevant from a risk management perspective and suggest that the industry should be building capacity. Thanks.
Thank you, Kevin. And to highlight your point that it is a material risk, there are actually study shows for every $500 increase in annual insurance premium for a standardized $400,000 mortgage, it is directly correlated to a 27 increase in delinquency rate. So the materiality is real. And in 2024 in Los Angeles, about 13% of realtors that have this experience is both the buyer and the seller are ready to sign the contract for the house sale, but they cannot proceed because they cannot secure insurance. So it is a real deterrent in the housing market. And Kevin, you also mentioned something as the role of insurance in predicting where and the trend of credit risk and the decreased value of collateral. I would like to maybe delve in deeper into that question of earning early warning indicators. So I would love to open this question to all panelists. So what indicators would you watch as early warning signals that the extreme weather is beginning to translate into credit risk? Thank you.
I can go first. I think we kind of all alluded to those indicators, insurance being the first line of defense, monitoring the trends in the insurance market, I think becomes very important. So paying close attention to any data that becomes available on availability and affordability trends is crucial. So there are efforts being made on this front. National Association of Insurance Commissioners, NAIC, as we all know, is now conducting. It did its first data call a few years ago, but now is going to do that every year, an annual data call to collect zip code level data from property insurers on various metrics related to availability and pricing. And I believe some of this information is going to be put out in an anonymized manner, aggregation of that, and will be made available in the public domain. So something to keep an eye on.
Thank you. I think the data is such a critical part. Another thing, I think banks, particularly smaller banks, that they already have some of the information related to insurance can be used as early indicators, such as the percentage of insurance payment amount within the escrow account payment. I think in some areas, the insurance payment has already surpassed other type of payment within the escrow account. So another information banks already have is like the delinquency rate by geographic or the FEMA flood zone overlay of the existing portfolio. So Eddie, I see you nodding. You probably have more tips. Thank you.
So some of the things, coming from the mortgage banking side. Um, so usually when a loan is originated, a bank can either sell the loan off to the secondary market, for instance, Fannie Mae, Freddie Mac, Ginnie Mae, and thus, the risk is basically passed on to the investor. However, many banks hold loans in portfolio. So especially smaller banks with specific geographic footprints, holding loans in portfolio, that's something that is worrisome, especially in more risky areas. The other thing we're seeing is that as may be expected, lower moderate income borrowers are more at risk from disasters than higher income borrowers. And why is that? That may be, historically through time, you know, um, for instance, if we just get back to Florida again, higher income borrowers may be living in large buildings where there are storm windows and or they're able to afford, resiliency, have roofs that are properly strapped down and won't fly off. Lower income borrowers may be living, closer to the coast in areas that have been susceptible to disasters in the past, may be living in, for instance, manufactured housing. And of course, those are going to be worse affected in disasters. So often we see, and it always breaks your heart when you go into, when you watch the news after a disaster, and it always seems to be the lower income borrowers. And of course, lower income borrowers are often have high delinquency rates prior to disaster, meaning that they are already, living paycheck to paycheck. One bad thing happens, perhaps they'll be unable to pay their mortgage. And given that they, are more susceptible to disasters, that's something that we really need to keep an eye on as well.
Yeah, and maybe just one or two things to add, because I think the comments hit on the important questions about where are prices and quantities of insurance changing in a way that send an important signal. And in this discussion, I think zero is a very important quantity. Where is insurance not available? And are there properties or regions that, for practical purposes, are becoming uninsurable? This is a topic I see more and more in the literature, with papers using some version of the word uninsurable in the title. And there's a little bit of debate about what that means, but to me, it is not only is there a price that a provider of insurance would offer, but is that price actually affordable given all the other demands from a consumer to make a market work in the way that it's designed to? And insurance markets are designed to transfer risk. That's a socially desired outcome, and markets should work to achieve that. One of the other conclusions from those papers is that the traditional tools like diversification or expanding risk pools or risk-based pricing might not be enough, and we're going to need other actions to actually limit the risk. And Eddie mentioned some of these, whether it's establishing and enforcing building codes, retrofitting existing housing, taking community-based approaches to build resilience for the community and not just an individual home. All of those are steps that society might need to take in a way to reduce risk that are a little bit separate from what financial institutions are responsible for.
Thank you. And we've seen a lot of questions coming in the chat already. A lot of participants don't see them yet, but the speakers were looking at them. So please do continue sending in your questions. We're going to open up for Q&A real soon. So before that, Rajesh mentioned there is a data collection by NAIC, and both Eddie, Kevin also touched on the importance of information. So well, my question is, where are the biggest information data or capacity gap today, particularly for community and regional banks? And how should those institutions deal with the gap surrounding say, flipping data, insurance coverage, or other supply chain effect with the local concentrated risk? Thank you.
Yeah, I'll start on this one. So coming from the mortgage industry, we generally have data on mortgage payments. So I can usually get data on what we call escrow. So escrow is the proportion of your payment that goes towards your taxes and your insurance. Often can't break those up. You can scrape data on taxes to get an idea of the insurance, but we don't get a full picture of the insurance payment. And why is that important to us? Number one, the research institute that I ran, the Research Institute for Housing America, we looked at, what would we need to include disaster data in regular mortgage models, default, prepayment, house price appreciation models. And really the author's conclusions were very simple. It's insurance premiums are a really good signal of the risk to a property. Insurance companies specialize in it. But if I don't get data on insurance and I don't know what the borrower's deductible was, and many other, factors that influence the insurance payment, then I don't get a clear signal of what the actual risk is to the property. So that is something, and of course, we're not going to get it because of data privacy laws, but it is something, coming from the mortgage industry that I would love to be able to get is better insurance data sharing.
Yeah, maybe I'll add a complementary point, and the way I think about this is to model these risks or the impacts of these risks, you need information about the shocks themselves. How has the frequency and severity of the underlying shock changed? And data around the vulnerability of what is the exposure that an institution might have. And one determinant of that vulnerability is really the detailed characteristics of the underlying properties. How was it constructed? Where exactly is it geospatially located? Has there been adaptation investments that can mitigate some of the impact? What are the precise details of the underlying insurance agreements, not just premiums, but also coverage and concerns about underinsurance and deductibilities? And my guess is that over time, we'll see much more of that data collected as part of the initial due diligence and credit review so that it ultimately factors into underwriting decisions, and it's just part of the normal course of business, normal good enterprise risk management business.
I would add to that, maybe the institutions need to be cautious of the recency bias. So, we're all kind of relying on up until now, and still happening. We're relying on past experiences to kind of get this false sense of safety that an event is not likely to occur anytime soon. This line of thinking supports the decision that business as usual, maintaining status quo, is the lowest cost option. But longer term, this can prove to be costly, as we heard from the comments before. So climate is an area, or rather, impacts of climate change is where history cannot serve as a perfect guide, and we have to look at science for better insights. So there are many downscaled, science-based models that are already publicly available, and many are being developed, and existing ones are getting refined. And I think that could prove useful in this work. So uncertainties will still exist, but caution is needed to make sure that one is not unknowingly betting the house. So look for other ways to get insights and look to science for providing not a perfect insight as to what future may hold, but provide ranges or possible outcomes that you can consider when planning for the future.
Thank you. And speaking planning for the future, my last question is when we talk about smaller banks and community banks, they have even more constrained capacities. So what does proportionate risk management look like for those institutions? I think Rajesh gave some, and Eddie gave some example, and Kevin has already summarized that. But to be very specific, like how can smaller and mid-sized institutions manage risk when they lack the geographic diversification or the advanced modeling capacity? Especially New York has the proportionate climate risk management framework. How do you see implementations? Any good examples? Thank you.
Yeah, there are many good examples. I mean, one I would highlight is, for example, heat maps. Heat map is a tool that can be easily deployed. All, the smaller and mid-sized companies, what they're doing, deploying a heat map tool is just kind of bucketing their risk. Like, where is it you think your exposure is to these, climate vulnerable areas? Most of that information is already available through public sources. So what I'm talking about is like a very granular level climate data is already available. Like the National Risk Index is one such source, and there are a few others. Our website, you can go to DFS climate change webpage for a list of some of these resources that you can use. But I would highlight that proportionate manner does not necessarily mean smaller size requires less focus, nor does it mean that firms need to develop very sophisticated modeling capabilities. What it does mean to have a framework in place, something along the lines of what TCFD has advocated, which is have a governance in place. So there's a cadence to how often you're checking whether an institution is exposed to any material climate risk or not. So have very clearly defined roles and responsibilities to manage these risks, and have accountability or at the C-suite level, and have a regular cadence to board oversight. In addition to that, I would say having very simple metrics in place, or a dashboard of sort to monitor these climate related risks. So those metrics, part of a dashboard, are allowing you to measure some of these risks, whether through a simple color coding mechanism in a heat map, or maybe a bit more sophisticated approach of some kind of a bar calculation. And last but not least, monitoring your client's exposure, closely monitoring your client's exposure to climate-related financial and operational risk is equally important. So collecting information on clients' exposure, their governance, and their strategies in managing their exposure to climate is important as well.
Yeah, and I think this is another good example where these sorts of risk drivers should not be thought of as separate from the existing risk management frameworks. Proportionate risk management is just a fundamental core component of any risk-based supervision or any risk-based approach from an institution. But as we discussed earlier, there is likely to be lots of variation across business models and geographic footprints. So that has to reflect some sort of proactive analytical assessment to identify the risks and then prioritize how you want to use your scarce resources. Time, energy, data, managerial bandwidth, these are all scarce resources that need to be allocated where the risk is the largest, where it's the most material. And in this case, when we're thinking about extreme weather events, I think the message from all of us has been that the past might not be a good predictor of the future. So you can't simply assume that the way you've managed risks in the past will be appropriate going forward.
Thank you. We are almost 5 minutes left. I think every speakers, panelists can see the questions rolling in. Feel free to pick the one that you would like to answer, either answer live or you can type in your answers. I'm just going to read out a few that I found particularly interested. One is someone, particularly to Eddie, the comment is the ESG lower their insurance requirement this year. There's no replacement cost on roof, charge, or coverage limits. And that will lead to a higher credit risk for the ESG. And this already forced risk taking for ESGs as a result of climate impact on insurance. So,
Right. Um, Let me try and answer that. I'm not 100% sure how to answer it, but obviously, if I'm driving, a 10-year-old car and it gets totaled, I have insurance to buy another 10-year-old car. I don't get money to go and buy a brand new car. Okay. But when you're talking about a roof on a condo building, of course, if the roof is totally damaged, you're not going to be able to get a roofer to put on a 10-year-old roof. You're going to get a new roof. So you're talking about replacement cost. However, a couple of things have been coming to light as far as I understand. Number one, the replacement cost is exorbitant and it was pushing up insurance rates. The other thing, that was becoming pretty prominent is fraud. So, there's a hailstorm. Somebody's got a 14-year-old roof, a 15-year, 15-year shingles, and they're at year 14. There's a hailstorm. They go out and they claim insurance and put on a new roof. So there's a lot of issues as well with fraud. And so taking the balance of the increased premiums and the fraud, I understand that the GSEs relaxed the replacement cost requirement. But that's just my understanding. It may not be complete.
thank you, Eddie. And we also see this is kind of a suggestion from Victor Cardenas. He said, shouldn't climate risk assessment or the modeling be treated as a public good through independent organizations or among regulators, and then translate into actionable information for market participants? We have regulators here. Any thoughts on that?
I think there are many publicly available resources there at the moment that can be leveraged. I mean, I alluded to the climate risk data that was available on the NRI website. That information is pretty granular. It's at a zip code level. It can also be viewed at a census tract level, I believe. So that can be used. And there are many others. I mean, UNEP FI is putting out a lot of research on this or reports on this. Series has, I mean, you guys have put out some reports on this. So I think maybe what is needed is somebody to put together a very detailed catalog on what is there available in public domain. We at DFS try to do that. So if you go to our web page, you'll find a whole list of different public resources that are available to anybody. So any mid and small size financial institution can use can rely on any of those resources. But I agree with the comment that I think a lot of this has to be done in a public domain where it's shareable because it's for public good.
Thank you. And Kevin, at a very high level, what do you think about the macro and micro prudential regulation, whether the risk affects financial stability? Thank you.
Yeah, that's another really, really good and hard question. Everything we've talked about here is really a micro prudential perspective around the safety and soundness of an individual institution. How do they manage their own risk? When you start thinking about financial stability drivers, things like spillovers and amplifiers and unexpected risk transfer, it just becomes much more complex because the economy and the financial sector are so complex. And there's been a lot of work on that the Financial Stability Oversight Council in the US, the Financial Stability Board internationally, the Network for Greening the Financial System have all thought about these different transmission mechanisms where these types of shocks can impact financial stability.
Thank you so much. We still have so many unanswered questions in the chat. I wish we had more time, but I want to be respectful to everyone's time. The recording will be available on our website. I look forward to continue the conversation with all the panelists and all of the participants. Thank you very much.
Great. Thanks for having us, Holly.
Thank you.
Thank you.